us today. Very excited to have this webinar with some amazing individuals. As many of you know, my name is Chris Lestrino, and I am the founder and CEO of KingsCrowd. We are also joined by our partners over at Early Investing, Vin and Andy, who are experts in their own right when it comes to this market. And lastly, we have Jordan Gillissie from Equifund. He's the CEO of Equifund. It's a new equity crowdfunding platform, actually out of Canada, but hosting deals that we can invest in here in the United States. And we're really excited to hear more about what they're building, what's differentiating them in the market, and obviously hit on a topic that I think many of us are wondering about these days, which is, how do we maneuver during these times of COVID-19, and how could Equifund and us within this market help you kind of navigate those waters? So with that, Vin, would love to have you kind of kick it off and ask some questions.
All right. So before we get into the bad luck of launching a crowdfunding platform right as COVID-19 gets going, let's start off with a little background, Jordan, which is you spent time in the corporate world. What did you do there? And then how did you end up in startup investing?
Sure. So the background on the corporate side was still investing affinity-wise. We were in investor relations. I was working with micro-cap companies, small-cap companies. Our role there was to help grow retail shareholder base so a company could increase market cap, increase liquidity, and then try and go raise capital. I've been in that space for 15 years, and in that 15 years realized that there are some massive gaps in that industry. We followed the Jobs Act really closely. And as the rules kind of revealed themselves, we thought this might be the way for these small companies that are essentially believing themselves to get public to try and raise capital and then stuck with this operational annual burn to just stay public to try and raise capital. Let's work with these issuers ahead of time. Let's get these guys properly capitalized before they go public, and then allow them to flourish as a public company instead of get public, try and keep up with the fees and have your hand out and raise capital. So we went from public markets to this. It was an easy transition for us. We've spent most of our careers soliciting retail investors into the market. And then on the investment side, it was interesting, as you start to identify the problems with the current makeup, the retail was always coming in when the company was in dire need at that kind of micro cap level, and buying shares at full pin retail, not participating in upside, anyway, it's a very toxic way of growth as a company, and a very tough way for investors to really try and make any sort of return, or at least predictive return. So we felt both on the company side and on the investor side, if we got into the equity crowdfunding space, we'd have an opportunity to get companies properly capitalized and investors in at early and favorable valuations, instead of being somebody's exit strategy when a company is already listed.
Yeah, no, that's fascinating. Before I get to the next question, I just want to touch on why you were attracted to crowdfunding. We got a little bit of it in the attraction to the upside and that sort of thing. But let's just dig a little deeper into what was it about crowdfunding that particularly appealed to you.
Sure. I feel like I got to go up on the psychologist bench here, and I'm going to look up at the ceiling and tell you why I did it. It's funny. It was a personal motive of mine was always access. The way the rules set up, as most of you know, the early and private equity investing was limited to accredited investors. And then also there's that geographical challenge of deal flow. And so I'm a smart guy, and I saw an opportunity that was presented to me with the right facts and information. I would love to participate. I also don't want to participate at the $50,000 level that you're asking of me. Yeah. I want you to respect me as an investor. I want you to allow me to invest whatever I can to participate in your deal, but give me that access. So that's why it was equity crowdfunding. When we went through the rules, it was accredited and non-accredited investor participation. It was going to be borderless. It was going to allow people from anywhere to participate in these offerings. It didn't have to be in Austin. It didn't have to be in the Bay Area. And that really resonated with me.
So when you're looking for companies that you want to, potentially put on the platform, we know each platform kind of has their own little flavor of what they're looking for. What is it that you're looking for before letting those companies onto the platform?
Gosh, like you got 4 hours because it takes us, 5 months to do due diligence on a company. Sometimes fundamentally we're looking for investable businesses. And that really becomes a tough one because it's tough to 0 and 1 that answer. But there are great lifestyle businesses where an operator can make a great living, but they can't take in an influx of capital, compound that growth, and in that business model, show a return for investment. And that's what we're trying to identify, at least at a very high level. When we get into the due diligence practice, we get into reviewing on management and their history, who's supporting them, their board of advisors, do they have corporate coaches, do they have an addressable market, defensibility, like the list goes on. But at a high level, that's what we're looking for. I'd like to say we're an investor first platform and we operate that way. So as an investor first platform, we need to make sure the issuers that are coming through the door are investable companies and their fundamentals support that.
Yes, Jordan, Andy here, hi. Listen, you cover both Canadian startups and US startups, right?
No, actually, interestingly enough.
Okay.
So Canada's been a really slow mover on the innovation side in the capital stack.
Yeah.
So actually, interestingly enough, this month or next month in May, Canada should be adopting very similar framework to Reg CF, which will allow for a federal exemption and these early stage companies to at least explore that sort of capital raise.
Oh, okay.
So right now it's all US all the time.
Okay. Are you at least looking at potential candidates in Canada and sort of putting them in a pipeline, or is it too early for that?
So we've had strategic conversations. The network here, because it's just we'll call it non-innovative in the capital raise process. The network here, we're associated and aligned with a lot of angel networks. Incubators are big here, but there's that big jump between incubation and angel and VC here, and that really is where the Canadian capital raise environment is falling short. With this new reg coming online, and I'll tell you, we had the foresight. We were making sure we were aligned and watching when these regs were going to come on. Our goal was to establish ourselves in the American marketplace, take that knowledge base and apply it here and be first mover.
Yeah, it's interesting. So if everyone's wondering why we're asking all these Canadian questions, it's because Equifund is based in Canada. Jordan, you're sitting in Ottawa. And so that's why we're asking the question. So one of the questions that brings up for investors is, all right, are you able to accept American investors sitting in Canada, or especially since you're doing American deals, or is it only Canadian investors? We've had all sorts of, we've got varying rules and regulations from portal to portal. Each portal is different. How do you handle that from an investor standpoint?
So our technology allows investment to come in from all over the world. Domestic, international, doesn't matter. It is at the discretion of the issuer themselves to make the choice if they're taking in domestic or international investors. We present that to them. We, at least to date, all our offerings have only wanted U.S. domestic investors, but the technology allows us to take in anybody.
Got it.
That's interesting. Do the companies explain why they only want U.S. domestic only investors, the startups?
It's funny. So it's usually their counsel that's influential in the decision.
Yep.
Being on this side of the border, we've been able to see how counsel feels about foreign investment. And that's been actually on the legal side. The crowdfunding industry has kind of had this gray area where they've said, okay, if you're an American issuer and you're taking in Canadian investors, wouldn't you have to meet that investor's guidelines? And the answer pragmatically would be yes, but nobody's enforcing it. So essentially they've just said, like, well, we'll kind of turn, not necessarily a blind eye, but we don't have the rules in place to do it. As Canada comes online, hopefully all you're looking for is the rules to be in place so that we can enforce them, right? Give us the boundaries and we'll play within them. But yeah, for some issuers, they are concerned of the legal risk of soliciting an international investor not meeting their local jurisdictional requirement and subsequently be exposed to risk.
Yeah, it's a very conservative approach, as you know, a lot of lawyers like to take.
100%.
So you have two deals on the platform right now. Curious to hear how you kind of source those deals and what you're doing to find more deal flow for your investors.
Sure. I won't name names because those guys are our deal flow guys are great. A lot of our deal flow comes from the traditional investment banking institutional approach. It's funny, both of the deals that came to us came from major VCs who felt the companies were either too early stage or the size of investment based on their internal mandate would be too big in the company, and thus they'd be too exposed to that particular company's outcome. So we've aligned with those, like family offices, the VC network for sure, where they're saying, get to Equifund, get in some money, grow, meet these particular milestones, and then let's revisit in 18 to 24 months so that we can take a more sizable investment approach.
And so you're a new investment platform, Jordan. How's the discovery going? How are startups finding out about Equifund? How are they reaching out to you?
We've been lucky to this point. It's been word of mouth, to be honest with you. We've been pretty good about taking a hard stance on who we are and what we're trying to accomplish in the space. And I think that resonates with some people. It's funny, I get notes every once in a while that our users are saying, like, I don't understand why the CEO is answering this regular question that I have. And I go, it's because, like, I want to get to know you, and then I want, when you get to know me, that you tell all your friends about us. And we've really taken that grassroots approach. So, you know, our customer service widget, if it's after hours, that's coming to me, and I'm talking to people, and I think they're really excited about what we're trying to do. And as a result, we're seeing our audience grow pretty substantially over the last 60 days.
Jordan, what you said they're excited about what you're trying to do. Now, let's dig into that a little more in terms of what you're doing with your portal. How is that different, or how are you doing it better, if not differently, from the portals that you're familiar with in the U.S.? Because, as you know, there are a lot of good ones.
100%.
In the U.S. and certainly, you know, they're reaching out to startups as well. And are you telling your startup candidates a little different story with a little different set of promises or benefits that the U.S. portals? What are your differentiators, in other words?
Well, so like I said, why I say we're an investment first platform. That's a creed internally. We are not an environment where an entrepreneur will come with a business plan or an idea and seek support. There are portals for that, and we champion them in doing that, and often refer companies that are in that corporate life cycle to go there and explore. When I say we're an investor first platform, as that mandate, we are doing everything we can to uncover every data point, bring in third-party experts to validate or scrutinize claims made by that company, holding them to timelines and communication standards that probably are outside most portals. I take that very public company approach because that's the space that I just knew and was in. Right? We're doing press releases, we're doing calls with shareholders. Like, these are the things that I think are so vital if you're going to go and ask the retail investor to put up their hard-earned dollars. So that's what we focus on. The other thing from the other portal and innovation kind of differentiator, there are things we're not. As I mentioned, we're not where you go to push your business plan. We're also not an exotic company. We don't do ICOs. We don't do security tokens. Like, that's not our space. Our space is institutional approach to crowdfunding, institutional investments, bringing that data to an investor so they can make an informed decision and know that they're going to have the continued support and commitment from the company to stay in communication with them as they achieve their milestones.
I'm just curious because, you know, when I interview founders, at some point in the conversation, I asked them what their end goal is, what their exit is, what they ultimately want to achieve for the investor,
Sure.
And so I get, some founders say, well, I'm only worried about growing the company now, pleasing the customers now. If I do everything I'm supposed to now, then the other stuff will come and will take care of itself.
Sure.
And I sort of push against that. Say, okay,
Yeah.
that's nice to hear, but I'm wondering what your approach is to that question.
No, you're spot on, Andy, and that's why we appreciate publishers like you and thought leadership like you asking those hard questions, and we ask the same one. I can't tell you how often me asking a CEO or the company's management, what does the investor get out of it? And they're stumped at that answer. And that's a fundamental problem, right? It's okay. So a CEO says to me, we're going to get acquired. Okay. So let's unpack that. Who's acquiring you? Are you doing business with them right now? Why are they acquiring you? On what basis? Do you have users? Do you have intellectual property? How have you already started that ball rolling? Like, we press and ask those questions and seek those answers because investors want to know. If you want to go public, gosh, that's my background. So I can hold your feet to that fire, right? So what, are you doing a reverse? Are you doing a direct listing? Are you being underwritten? Who's your auditor? And then all of a sudden I go like, well, it turns out I think you're just saying words for the sake of saying words.
So I had an interesting question coming from the crowd that I'd like to ask you, which is, are any industries excluded from your platform? And they put, for example, biotech.
Absolutely not. I think our industries right now are very akin to what you see in capital markets. So we're in oil and gas right now doing due diligence, biotech, pharma, consumer manufacturing, fintech, and logistics. These are the deals that we're doing homework on right now. So no, a biotech comes down the pipe, great. We have actually resources that we use, including Chris, for example, who can help us on the research side, and the guys over at KingsCrowd on the research side for biotech plays. And that's what's wildly important. We understand we can't be an expert in everything. And that's why we pride ourselves in bringing in this thought leadership who can actually validate if you're a biotech company and you're making these claims. I got somebody smarter than me who's going to make sure those claims are accurate.
And one other question that was asked was, what costs and fees do you charge and how are they payable? And curious to hear if you don't mind disclosing, both on the investor side and on the company side.
So on the investor side, there's no fee to join. There's a transactional fee of $24 right now. And we found that falls right about in line with the cost of the trade. We felt as though when we were building out the model, if an investor is going to invest $1,000 and there's $24 essentially of kind of no man's land, was the issuer going to get $976? And so we essentially, we tried it out and investors seem to be comfortable with the $24 investment fee. On the compensation side, we take an investment banking approach. We take 7% of the capital that was raised and take a 7% equity stake of the equity sold in that particular offering. So what you hear in that is we're long in these deals, fundamentally, right? It's great for us to get 7% on the capital we raise, but we're looking at this equity as this is our participation. Our issuers are part of our portfolio. We need champions, and that's what we're on the look for.
Speaking of champions, what exactly are you looking for in the startups that come to you? What are the criteria you're cycling through? You touched a little bit on this earlier, but let's just get a better sense of what that is.
Sure. So ultimately, at the high level, outside of being the investable company, if we go to get into the nitty gritty, is management. So we start there because at the end of the day, if you have the best business idea, if we can't execute on it, it's a non-starter. So we're looking at we absolutely take in resumes. We're taking a look at their experience in the channel, who their support system is. Then we're looking at the market. Is it a micro market or macro market or wide market? Do they have defensibility either by way of IP, trade secrets, relationships? Then we get into the numbers side, for example. Operationally, I'm asking my guys, do you know your cost of acquisition? What's your attrition rate? What's the LTV of your customer? Like, these are all the numbers that they have to provide to us in our onboarding and due diligence package. Then there's the corporate side of numbers, right? Like, what's your valuation and how did you get there? And it's so funny where there's that huge disconnect in like, well, I think well, okay, why don't we bring in somebody like Chris and they can give us a number and let's see how that falls from where you guys were. Because at the end of the day, we still need to provide value to investors. We're an investor platform. So, okay, we don't want to just have our investors pay full retail. There should be a discount because this is early stage. There is going to be risk. I need to have that baked into the offering. So it's really important for our issuers to understand their numbers. Use of proceeds is always a fun one, right? Somebody says to me like, oh, we want to raise $1 million. And I say like, okay, so what are we using it for? And you get like, operational and marketing, right? I'm sorry, that's not good enough, right? I mentioned to you guys earlier, it's important for us to identify how money coming in is compounding the value of the company and then growing it. And unless there's a direct correlation between those use of proceeds, that's usually a big red flag for us. We're looking at previous funding rounds as a big one for us. Who's invested, either at the angel side and institutional side. I think that's important just to see. Also anecdotally there, I ask my issuers if they've done friends and family rounds. Not for the crowdfunding, but actually ahead of time. And they kind of go, why? And I said, it's always the same story. If you guys are such a great company and you are moving mountains, and we agree with you, we want you to be moving mountains. Don't you want your family and friends to participate in that growth? And you got to have a good answer for me as to why you're not doing it. These are the people who you are with on a daily basis. If they can't support you, they don't see that you can execute. That gets me kind of nervous. And the lastly, and most importantly, how are you bringing value to shareholders? Like we touched on that. What are our guys getting out of this? What is going to be the long-term strategy? And then scrutinizing it and then making sure we attach milestones to that growth.
Do you have any strong feelings about common equity versus preferred equity? Or do you accept both kinds on your portal?
It's a good question. Right now, to date, it's been common equity. I come from public company background, so common equity is actually quite valuable. We make sure that the equity has voting rights, and that was a big one. As we were doing our homework on other portals, it was like, okay, so you might have had this exotic equity piece, or it was common equity, but there was buybacks or no voting, or everybody was going to lumped into one, and if something better came along, they could wipe you out. We're making sure that investors are getting actual ownership in these companies and a say in what the company is doing.
How about safes or convertible notes? Are you accepting that, or does it have to be some form of equity investment?
I haven't come across a convertible note yet, and I'm not opposed to it. Safes, I'm not a big fan of. Safes, for those of you who are unfamiliar with safes, it's essentially a promise for the company to deliver equity upon a future event happening. I don't like that. There's something about that at the end of the day that I want to make sure that my money is going into the company and I am getting a direct compensation for that investment.
Yeah, for sure. The devil is in the details when it comes to safes, right? That event, how is that event characterized? What are the exceptions? We've had, a couple of experiences where a company has had a liquidity event that unfortunately excluded early investors. So you really have to look on a case-by-case basis at the legal language, at the small print of the safe to be sure it's okay. So that's what we're doing. But overall, I think your suspicion or skepticism or cautiousness in regard to safes is warranted. So yeah, I think that's a good one.
It's great that you guys are uncovering that as you guys are bringing deals to market for consideration. It's also up to the portal to make that very clear at the front end of the investment, what this means exactly, what you're getting, or this exotic product. I think it should be first and foremost. And we hear that all the time from investors. When we present an opportunity to them, they want to know the price per share, the type of equity, and the valuation. These are pillars to them, right? So I hear that story, Andy, and I think those can be some of the shortcomings of this industry, right? If we're going to take this thing seriously and it's going to get massive adoption and traction, we can't have these kind of backdoor equity programs or doled out programs that we don't win in the long run.
Absolutely, absolutely. To be clear, Jordan, do you just do raises under regulation crowdfunding, or as it's known, regulation CF, or do you also will you be also doing raises under regulation A+, which you can raise a higher total, and there are different rules governing that raise than the CF raises?
So good question. Currently, we've only done CFs, and both of our CF issuers came to us with the intent of doing a Reg A. And my approach to them was really simple. Look, the mechanics of the CF are going to be very similar to the Reg A. And before you embark on this hundreds of thousands of dollar journey to get a document that allows you to raise a substantial amount of capital, let's make sure that there is an audience for your deal. Let's make sure that your cost of capital absolutely is as low as it can be right now. And if you see that success and you are seeing at the CF level, then go ahead and file Reg A and we'll be happy to host it for you.
All right. Speaking of cost of capital, let's get sort of to the the viral size elephant in the room here, which is how is COVID-19 affecting the market? How is it both affecting you from Equifund standpoint, but also the larger capital market, the startup market, and what are you seeing there?
So it was interesting. I don't want to sound like there was some optimism here, but our phones rang quite a bit more in the last 3 weeks, if I was to do a blended average, only because issuers that we had talked to in the past who thought crowdfunding might have been beneath them, or they were maybe a little, all of a sudden, there is a cash crunch or potential cash crunch, and they want to come back and get in line and explore this to some further detail. So that's been interesting on the issuer side. I think everybody's trying to find some comfort and fill the coffers right now to sustain a little while. So yeah, we're seeing more issuers at least call. On the investment side, I can see engagement has been down, which is interesting. And I'm sure all of us are feeling it. All of you guys have big audiences. I think there's a little less tolerance for some newsletters or some information right now as people kind of recalibrate what's important to them in their lives. From an investment standpoint, however, there's been a steady stream, and that hasn't changed actually since day one. There's been this steady stream from investment. I'd like to think it's a testament that our issuers are in their respective industries not deemed an expense. They're still creating value, still innovating, still fitting a fundamental need, and investors understand that. If you're deemed as kind of this long shot and what could happen, obviously, it's probably not the right time to raise capital. But if people can see linear your adoption and innovation in that particular space, yeah, you're still going to get backed right now. I'm pretty confident about it.
Yeah, I think we track all of the platforms, every one of the deals, and we track the actual volume of dollars going into every one of these organizations. There's about 333 live companies right now across all of the platforms, and we've seen, I think in the first week, about a month ago, when everything started to go haywire, we saw a dip of about half of investments. Like it kind of shut off for a week, but then what we saw is it ticked right back up to normal. And actually appears to be on a stable, if not growing path from where it was prior. And I think from what we've been able to kind of assume and piece together is there's almost this feeling as though while this may be a very risky asset class, the reality is you're not going to wake up tomorrow if you put in $100 and there'll only be $10 left because the market went crazy. The reality is put in that $100 and you'll find out what happens to it in 5 to 10 years. And there's actually a feeling of comfort with that, because at least, my money's going there and, hopefully it grows in value, but nothing's going to happen in the immediate future because of what's going on, which is, a comfort to many people. So that's been good to see. And definitely companies appear to continue to be able to raise capital even in this environment.
And I think that's a really interesting insight. Andy and Vin, I would ask you, you guys have a cult-like following. You guys have been thought leaders in early stage investing. A lot of the feedback that we saw from our readers is that they felt as though they were too market exposed over the last 5 years. And now they would like to diversify. What are your thoughts on crowdfunding as a diversification method?
I'll let the cult leader go first.
Just don't touch the lemonade, please. I think it's a great time to diversify into the startup field because of just what Chris said. You're not going to wake up and see a 50% or 80% loss. On the other hand, I am not telling our members that they should take money out of their public stock investments and put it into startup investment opportunities for a very good reason. You don't sell low. That's not how you make money. That's how you lose money. So I will never advise my members to sell low, even if it's from a faltering, stumbling, possibly crashing stock market. But you see the stock market goes up one day, 2-3%, it goes down the next day. I mean, it's just really up and down. It's very volatile. Now, if they want to get out of the stock market just because they're losing sleep over it, that's a different story. If they want to get out of, if they want to step away from that kind of volatility, I understand that. And step into something that is much more stable, which happens to be the startup market, because this is going to be ancient news by the time these startups that are raising now, by the time they hit a liquidity event, 3, 5, 8 years down the road, this is just going to be a blip. But it's a great time to, if you have any extra cash, we're telling our members, now is a really good time to invest in your favorite startup. It's not for everybody, but the startups that are able to raise now and have good technology, good products, they're able to execute. The weak sisters, the weak startups are going to sort of fall by the wayside, right? And so they're going to have fewer competitors. It's going to be easier to acquire, cheaper to acquire talent. There's some benefits to starting a startup right now. So you have to look at, it's funny because I'm looking at the valuations the valuations that I would be very pleased with now in the startup world, or that I would be very pleased with a couple months ago, 3 months ago, 4 months ago. I'm looking at these startups as, well, it's 8 million, should really be 5 million now, or it's 12 million, should really be 10 million now. I'm already beginning to veer. So I'm looking at, with all the uncertainty, it should make price points, not only in the public sector, but in the private sector, much more appealing to early investors and to our members. So I'm keeping a close eye on that as well. But I advise my cult-like following that this is a great time to be investing if you have the cash.
Yeah, I mean, look, there are two pieces to it fundamentally, right? There's the psychological piece and there's the environmental piece. Right now, it's like a giant Rorschach test. I mean, what kind of investor are you? It sort of divides you into different categories depending on how you see the ink box. And so there are people who see the market fall and they're like, "Yep, time to go bargain hunting." And there are people like a good friend of mine. And a friend of mine did that. He just called me up, said, "Yep." He's like, "I got to go. Market fell. Time to go bargain hunting." And another friend of mine said, "Yeah, I just moved everything into bonds." I was like, "Well, why'd you do that?" He said, "Over the course of the next 5 years, you're going to make so much more money in the stock market." He says, "Yeah, I just can't handle on a day-to-day basis a 10% drop." He says, I know over 5 years that I'm going to be more profitable in the stock market because everything will bounce back, and you get. He says, but just psychologically can't deal with it, can't handle it, and so a lot of this just comes down for the investor, just knowing who you are, and if you're looking for a place that you don't have to think about the markets, you don't have to worry about the markets, you're going to put your money in 5 to 10 years later, hopefully you get a 10x, a 100x, a 500%, 1,000% gain, then the startups are the great place to be. So there's this huge psychological component to it, and then there's this sort of market reality, which is some of the best startups and some of the best companies we've ever had were founded in the middle of financial problems. And some of the best companies we've ever had have actually gone through, hit the bottom in a financial, and come back up. And so there's a lot of historic data surrounding this. And so when you think about it in those terms, you're like, well, yeah, wait a minute. The startups that are actually able to raise capital in this environment, they're doing something right, and they're doing something well, and you've got to pay attention to that. And not only do you have to pay attention to that, as Andy mentioned, you've got the valuations that are likely going to be coming in at a lower price point because there's a bit of an increased risk in the market. So you're talking about potentially getting in on the next Netflix, the next eBay, the next Amazon, the next Uber, whatever it is. You're potentially getting in on a much lower valuation and a much lower price than you would 3 months ago, 6 months ago, 8 months ago, or than you would maybe a year or two from now. And so there's a sense of opportunism there that's really important. And so if you have the money to be able to invest, now's the time that you really want to go looking. And once again, psychologically, it's the toughest thing to do. Psychologically, it's the toughest thing to buy stocks in a falling market. You're afraid of falling and catching knife, but you want to buy low. This is how you get into the market on the cheap, and it's the same thing with startups. This is when you want to buy. You just have to do your due diligence, like you do, Jordan, on the platforms, like Andy, Chris, and I do. For KingsCrowd and Early Investing, that due diligence becomes that much more important. But I'm of the firm belief that we're going to see some terrific startups raising, and the fact that they got to the point where they can raise in this environment just speaks all the better for them. And we're going to see some great value, and we're going to see some great investments, and there are going to be some strong companies that emerge out of this.
But Jordan, there's a couple things you could do to make our jobs easier. Not that I would ever tell you in a million years how to run your portal. But there's a couple things you could do.
Yeah, let's hear it.
I think one is really emphasize capital efficient companies. Companies that can make their dollar stretch, because money is becoming a precious commodity, more and more of a precious commodity, right? It seems like it changed overnight from a lot of dry powder out there to now where, people are sort of pulling in their investors and sources of capital are sort of, pretty quickly taking a very conservative approach and hoarding their capital. So startups that before could, sort of assume that, they'll be able to, get out there in a half year or 8 months or 10 months, and raise again. Yeah, I would like to see a minimum of 18 months between raises now. So that's number one. The second thing is, if I were you, and I would never tell you how to run your business, I would really emphasize a low minimum. The lower, the better. And let the investor decide, if it's a $50 minimum will not prevent a person from still investing $100, right? So I would say the lower the better. I like $100. I don't like 500. I don't like 1,000. I like 100. Lower than 100, I even like better. And let the individual person decide if they want to do a multiple of that and invest 200 or 300. I think that would make it more appealing for individual investors, make it easier for them to put the amount of money they're comfortable with into a startup of their choice. Not that I would ever tell you what to do.
Sound advice, Andy.
So one question that came through, and we will try and get to as many questions as possible, and we could also try and follow up after as well, but do feel free to enter them into the Q&A section. We already have several. One of the questions that came through that kind of goes to your point, Andy, around if you have the cash, well, one of those places where you may have that cash is in an IRA or solo 401k. Are you accepting investments from those vehicles?
Yeah, we are. So you can invest from your 401k or your IRA or from an LLC and an IRA.
Got it. Excellent. And another question that came through is that it seems that most portals leave the advertising and marketing component up to the company with little guidance. How does your portal help with advertising and marketing? And do you help companies come up with a plan?
Yeah, so that's on the issuer side, we've spoken a lot about our investor first creed. On the issuer side, based on our background in investor relations, gosh, that's what I've been doing for 15 years. We know where to find investors. We know the language that they speak, the information that needs to be presented to them for them to make educated decisions. And we will absolutely guide the company through the media buying, creation, and execution side of the capital raise.
Excellent. Vin, did you want to go?
No, you got any more questions in the queue? If you do, send them in. Otherwise, I'll keep going.
Sure. All right, let's see. Did I understand that you charge a 7% fee of the amount successfully raised? And if so, how do you answer those who might say this is an inherent conflict of interest?
I don't know if I particularly understand the conflict of interest side. This is a model that we're not thought leadership for that pricing model. There were some portals ahead of us who started there, some investment banks who started there, so we followed it. We understood what it took operationally to put these deals together. There's a lot that goes on around the scenes. There's a lot of hands that are involved in putting together an offering, making sure that it's meeting the regulatory requirements and subsequently can be seen through to maturation. So, our model is just that, is one that we can operate the portal, make sure we can keep the lights on, keep people employed, but also that there's enough value in what we're doing for our issuers to consider Equifund as their crowdfunding partner.
Yep, that makes total sense to me. And, in our experience, every portal is charging right between 5 and 8%. And I think end of the day, it is tied to how well the company does in raising that capital. So in many ways, your kind of mission is aligned with that of the organization. I think that's the business model we've created, and it appears to be working for this industry. So I'd say, nothing out of the ordinary there from anything we've experienced across the 50 plus marketplaces that are out there.
Speaking of the business model, sort of looking at the crowdfunding business model moving forward, what are the biggest impediments to the growth of crowdfunding? What's going to keep it from seeing more mainstream adoption?
It's a sensitive one, Vin. I'll tell you what needs to happen for mass adoption is wins. We're a month away from the 4-year anniversary of the Jobs Act and this becoming a viable model. So there's going to be data coming out shortly about the early companies that raised and what they've subsequently done with it. I think that investors need to hear of champions and success stories where companies were able to execute, essentially just deliver on what they say they're going to deliver, and have that 1 in 10, 1 in 20, have that liquidity event or that exit that it's never going to be 1 for 1. That's the reality, right? But we're hoping that 1 out of 10 hits that big swing, and that's what we're going to need. I think we're starting to see, as you guys know, and everybody's following, they're moving some money limits, which would be great. That will allow maybe some different issuers to consider crowdfunding. It's funny, gosh, companies come in and go like, well, it's only $1 million. And you go like, be interesting to see if you guys know how hard it is to raise $1 million out on the street, but at least 5 million will give that ceiling or that impression that it's, something they should consider. It also falls nicely between that seed and Series A, which is that dreaded bridge round that no institution wants to take. Nobody wants to be the guy to get you over the hump you know, for big VC investment. And if crowdfunding can be that, then great. Let's be great at it. Let's be that, you know, that mechanism where you do raise 1 to 5 million to validate everything you know inside, but to have the numbers that support it so that you can go and raise that next institutional round.
Jordan, do you have an exit in mind that you think is a great cutoff for early investors to aim for? And if so, is that 50 mil or 100 mil or 200 mil or 500 mil? I mean, my feeling is that, you know, we're not in the VC investor space here. We don't need unicorns. We don't need startups IPOing at, you know, a multiple of billions of dollars, right? We don't need that for seed stage investors to be really, really successful with their stakes. So do you have an amount in mind that you hope the startups exit at to make your investors feel good about investing in the companies on your portal?
So I do. And I bet you if my phone was on, my counsel would be buzzing it, telling me, you can't give, like, you can't give advice, you can't give numbers, right? But that's why my phone is off. I think there's two sides to that. I think there's the emotional side of a business executing and keeping the investor aware of the executing and those milestones that they're delivering on. We wanted to raise $1 million. With that $1 million, we were going to bring on 10,000 new customers. And in our SaaS model, that meant $4 million of top line. Like, that's what I think that's the short-term win. From a return standpoint, you're right. Because you're in so early, you don't need a unicorn to see compounded returns. What's interesting is you're going to start seeing a combination of CF issuers move to a Reg A and let the CF participants actually be part of that liquidation in Reg A, which will be a new paradigm in how to kind of gauge early stage investing. When I think we're just kind of scratching the surface there of what could be.
Yeah.
Yeah, absolutely. Now, I would like to ask you a question. You know, you're a Canadian. You've had a lot of dealing with both American and Canadian startups. And I know in my conversations, not necessarily with Canadian institutional investors or startup investors, but with European investors. They look upon the U.S. startup scene with a little bit of skepticism. They think that there's too much of an emphasis on hyper growth, that the valuations are too high. This leads to distortions, you know, and a misalignment of interest between the startups themselves and the investors. You being from Canada, I don't know if you're sort of halfway between, you know, the European perspective and the U.S. perspective, but, you know, and I'm sure you have your own feelings on that. So you know, we're looking at U.S. startups from inside the U.S. So I would welcome, you know, your Canadian perspective on it. Yeah.
Well, and I can tell you my perspective will only be my own. Our issuers haven't taken in Canadian or any international investment, so I don't have that feedback from them. You can call it skepticism, but I think in there, Andy, there's probably a little bit of envy. There are some specific hubs in your country that are synonymous with innovation and venture capital. And we don't see that anywhere else. Gosh, like our biggest tech hub in Canada, it tries to call itself Silicon Valley North because there's envy there, right? From a valuation standpoint, you know, it's always tough to fall on numbers just because 6 months ago, even as early as 6 months ago, it seemed like there was access to capital. The market was never going to lose. Like there is going to be a significant recalibration right now. And as you mentioned earlier, valuations are going to be highly scrutinized now, where there is maybe just this passive attitude of show a little bit of traction and we'll see what happens. Now we're saying it's like, not only do I need traction, not only do you have to have a low burn rate and bring in customers, I need you, like, there's going to be that scrutiny level attached with these valuations now for sure.
Makes a lot of sense.
Yeah.
Curious if, in that recalibration, are you concerned? One of the questions that had come through from the crowd is this idea of, well, are we just going to see more of these companies go under? And if they're only raising the $1 million, how long a runway does that give to them? How do you kind of think about that concept of, can they survive or weather the storm?
Sure, and I think that's a very valid concern, but one that should have been examined in the due diligence process. Is the issuer raising capital to keep the lights on right now? That's a significant problem, right? Fortunately, our issuers on the current offerings right now are not in cash crunches. And as I mentioned to you earlier, their customers and their industries agree that they are vital to the growth of their specific industries. And that's why I think they're going to be okay. But you're right. And I think that's going to come back. We are going to see a bunch of issuers on platform raising capitals to keep the lights on, because it's also a necessary evil. We do have to support entrepreneurship and we have to support our economy, and we wish them luck. I like I said, it's not the first time and the last time that I recommend an issuer to a portal. That's just not ours, because that's their model.
What defines success for Equifund this year?
Bit of a loaded question, but okay. I'd like to say, there's corporately, I'd like to grow. We run a great little team here, but we really want to expand on our audience and our communication to our audience. We've got access to some really great minds in particular disciplines, and I want to share that with our investors, or with our subscribers rather. So growing out our team internally and being able to provide users with actionable information or actual insights, I think it would be a really big, a tall order, but one I think we can execute on. From a project perspective, it's funny, I don't have a number for how many deals I want to run this year, and I'll tell you why. I just want to run good deals. I've got a whole bunch in the pipeline right now, but the math tells me that not all of them are going to make it through due diligence, and that's okay. And let me be clear, when a company doesn't make it through due diligence, it's not no forever, it's no, not right now, at least not for what we're trying to accomplish, right? But yeah, success will be more users, probably better lines of communication to those users, and then some compounded growth on the amount of issuers we bring to market.
Jordan, are you at the beginning of a wave? Are we going to see a dozen portals from Canada start up over the next few years? What do you think?
It'll be interesting. So when in May of this year, we're supposed to get this Canadian harmonized exemption. Currently, the rule structure is broken down at what we call the provincial level. So you guys, it would be the state level. So imagine doing an offering, registering at each state, and each state having different risk and disclosures, different investing minimums and maximums. Like, it'd be an administrative nightmare. So with the new harmonization come online, I expect us to be pretty active in that space, or at least at the regulatory level, meet those requirements. If I'm building the company that I have a vision for here, we are so connected to American markets, especially in the cannabis run. All of that came up here through the Canadian Stock Exchange. You guys are used to investing up here. We're used to investing down there. Let's just enable that for early stage and private companies.
Excellent.
Yeah. We have anything from the crowd, Chris?
I'm sorry,
please.
Andy. I don't know if I answered your question. Will we see a saturation of portals from up here? We may. I can tell you they won't go through the FINRA registration process, because since we're all friends here, that was a miserable process to go through, and I don't wish that on anyone.
Just how long? Because you're FINRA and SEC certified, right? What was that process like? Why did you get through both? And just give people an idea just how miserable that process really is.
So the reason behind it is if you're going to present yourself as this button down portal, you need to have the accreditations and the certifications and the registrations that go along with it. We are held to a higher standard as a FINRA member. The SEC has rules in place that we have to follow, so that it was important for us, if we're going to be long in this game for us to get those and meet those requirements. It took about a year and a half. And why it took a year and a half is there wasn't a rule framework for a Canadian company wanted to abide by American rules in this outside jurisdiction. So there was no precedents to call on. So essentially it was, two lawyers on each side of the border running up a tab and, us trying to meet those bills.
Well, I think this is a great place to kind of close it. It's been a fantastic discussion, and Jordan, thank you so much for taking the time today. It's been a really interesting one. And fortunately, in a week, which all of you will be getting an invite to very shortly, we'll be sitting down with one of the companies on the platform right now, Illusio, and getting to know more about the founder and CEO of that organization, which will be great. We'll have more information on that coming very shortly. But appreciate all of your time today. This has been a wonderful discussion, and stay safe.
Thanks for coming on board, Jordan.
My pleasure. Thanks, gentlemen. Bye for now.
Thanks, guys. Bye. Take care.
Bye-bye.